From 1930 to 2023, dividends accounted for approximately 40% of the S&P 500's total return. During this stagflationary decade of the 1970s, a period of flat stock prices and high inflation, dividends were responsible for a staggering 73% of the market's entire return. Price appreciation gets the headlines. But for nearly a century, it has been the slow, steady, and often ignored drip of dividends that has served as the silent engine of compounding wealth. In the next 10 minutes, you will learn exactly what a dividend is, the critical metrics you must use to identify safe and growing dividend streams, and a powerful, advanced strategy for using them to build a true passive income machine designed to last a lifetime. A dividend is a direct distribution of a portion of a company's profits to you, the shareholder. When a mature, profitable company generates more cash than it can effectively reinvest back into its own business, its board of directors may choose to return that excess cash to its owners. It is a tangible reward for your part ownership in the enterprise. It is the business sending you a check for your share of the profits. The power of dividend investing, however, is not just in the cash it provides. It is in the magic of compounding through reinvestment. When you automatically reinvest your dividends, a process known as a DRIP plan, you use the cash payment to buy more shares of the company. Those new shares are now entitled to their own future dividends. This creates a powerful, exponential snowball effect. Your ownership stake in the company grows, and your passive income stream grows, all without you having to invest another dollar from your pocket. A consistent, rising dividend is one of the most powerful signals of a company's financial health and a management team's discipline. But not all dividends are created equal. In fact, the single most common mistake investors make is chasing a high yield, a mistake that often leads to catastrophic losses of both income and principal. So, what is the crucial metric that separates a safe dividend from a dangerous one? To build a reliable passive income machine, you must learn to analyze a dividend not as a single number, but through the lens of three critical pillars. Theory: the three pillars of dividend analysis. The dividend yield. This is the headline number. It's the annual dividend per share, the current share price. A $2 annual dividend on a $100 stock is a 2% yield. It tells you your immediate return, but it says nothing about safety or growth. The payout ratio. This is the most important vital sign. It's the annual dividend per share, the company's earnings per share. This tells you what percentage of the company's profits are being used to pay the dividend. A ratio below 60% is generally considered safe and sustainable. The dividend growth rate. This is the historical, annualized rate at which the company has increased its dividend payment. A long history of consistent growth is a powerful signal of a healthy, shareholder-friendly business. Analogy: the wise orchard farmer. Think of your dividend stock portfolio as an apple orchard. The dividend yield is the number of apples you harvest this year. It's your immediate reward. A large harvest is tempting, but it doesn't tell you about the health of the orchard itself. The payout ratio is your harvesting strategy. A reckless farmer who harvests and sells every single apple, 100% payout ratio, has nothing left to reinvest in the health of his trees. No money for fertilizer, new equipment, or soil improvement. The orchard will eventually wither and die. A wise farmer, a low payout ratio, harvests only a sustainable portion of the apples, using the rest of the profits to strengthen the orchard, ensuring it can produce even more apples next year. The dividend growth rate is the tangible result of the wise farmer's strategy. His healthy, well-tended trees naturally grow larger and more productive each year. His harvest isn't just sustainable, it's growing. Example: the trap versus the compounder. Company A, the yield trap. offers a tempting 10% dividend yield, but a quick look shows its payout ratio is 130%. It is paying out more in dividends than it earns in profits. This is a red flag. The dividend is being funded by debt or by selling off parts of the business. A dividend cut is not a risk. It is an inevitability. Company B, the dividend compounder, offers a modest 2% dividend yield, but its payout ratio is a very healthy 40%, and it has grown its dividend by an average of 12% per year for the last decade. This is a high-quality business. It provides a safe, reliable income stream today, while retaining 60% of its profits to grow the business, which in turn fuels the future growth of your income stream. This is the foundation of long-term wealth management. Understanding these metrics is crucial for avoiding the two most common pitfalls in dividend investing. Pitfall number 1. Chasing high yield. As we've seen, an abnormally high yield is more often a warning sign than an opportunity. It is typically the result of a collapsing stock price, which artificially inflates the yield right before the company is forced to cut its dividend to conserve cash. Pitfall number 2. Ignoring valuation. A great company can be a terrible investment if you overpay for it. The fact that a company pays a dividend does not exempt it from the laws of valuation. A safe dividend is worthless if the underlying stock is 50% overvalued. You must buy these income streams at a reasonable price. Avoiding these traps is the key to building a reliable income stream. But for those looking to build a truly optimized passive income portfolio, there is a more sophisticated approach than just buying individual stocks. The advanced strategy, the dividend barbell. The professional approach to dividend investing often involves structuring the portfolio into two distinct sleeves, or a barbell, that are designed to achieve different objectives. The core, 70–80% of the portfolio. Dividend growth. This is the foundation. This sleeve is dedicated to high-quality companies with modest yields, typically 1 to 3%, but strong balance sheets and a long history of consistent high single-digit or double-digit dividend growth. These are your dividend compounders. The primary goal here is total return. The growing dividend is the proof of a healthy, growing business that will also deliver capital appreciation over the long term. The satellite, 20–30% of the portfolio. High yield. This sleeve is your income-generating engine. This portion is invested in assets where the primary return is the high current yield. This could include a basket of well-vetted, high-quality real estate investment trusts, REITs, stable midstream energy partnerships, or high-yield dividend ETFs. The primary goal here is maximum current income. This barbell strategy gives you the best of both worlds. The core of your portfolio provides stability and the long-term compounding growth of both your capital and your income stream. The satellite sleeve provides a powerful, immediate boost to your passive income. It is a more nuanced, risk-managed, and effective approach than simply chasing yield or only buying low-yield growers. Let's distill this into the 3 essential principles of dividend investing. Dividends are a direct share of profits. They are a tangible return on your ownership, and through reinvestment, one of the most powerful and historically proven engines of long-term compounding. Look beyond the yield. To find safe and sustainable dividends, you must analyze the payout ratio, ideally under 60%, and the historical dividend growth rate. A safe dividend is a growing dividend. Structure with a barbell. The advanced strategy is to build a core portfolio of high-quality dividend growth stocks for long-term total return and supplement it with a smaller satellite portfolio of high-yield assets to maximize your current passive income. A well-constructed dividend portfolio is more than an investment strategy. It is the creation of your own personal pension. If this analysis provided you with real value, Invest a single click in the subscribe button to get daily access to the codex. Knowledge is the new capital. We'll see you tomorrow.